Hello, and welcome to another edition of the Well Balanced podcast from Vector Wealth Management. My name is Ezra Firkins, and I'm here with Mike Nesheim. Mike's a senior wealth advisor here at Vector. Mike, welcome to the show.
Thank you, Ezra. Appreciate it.
Today, we are going to discuss another scenario. It's one of my favorite things to do is kind of play things out, kind of hypothetical. And for those listening or watching at home, this may be something that you're going through now, or maybe a friend of yours is, and we encourage you to share this episode with them. So Mike, my plan is I'm going to kind of lay out the scenario, and then we'll get your take on it and kind of work through the if, how, and what ifs. Yeah?
Absolutely.
Sounds good? All right, so the scenario is I'm 60 years old. I'm about 5 years from retirement. We've got it's called a target date fund, and Mike, I'll ask you about this in a minute. And in that target date fund, my wife and I, we've saved up about $2.5 million, which is great. We're really happy. We're excited to retire here in 5-6 years. Let's first kind of answer, what is a target date fund? In my case, we're going to look at like the Schwab Target 2030. There's another one, Vanguard has one too. It's a 2030. This is inside my 401k.
Mm-hmm.
So talk us through, what is that fund? What am I holding?
So within the target date funds, what they are is a fund of funds. So you're actually in that target date fund, for instance, a Vanguard 2030 fund or a Schwab 2030 target date fund. It's a fund of funds. They actually invest in other mutual funds or index funds.
ETFs, maybe.
ETFs that are large companies in the U.S., small companies, international, bonds, etc. It's diversified at low cost, which is good for the right ones.
Mm-hmm.
That can be very helpful for some clients that have smaller asset sizes within their 401ks. We see it a lot, and that allows them to be diversified properly. And what a target date fund strategically does, it's called a glide path. So when you first start investing and you're younger and it's a long-term target date fund, say 30, 40 years out, it's going to be higher invested in stocks, higher percentage. Mm-hmm. And it slowly decreases that stock percentage and adds bonds and cash to the portfolio over time to a point where when you're 5 years out like this, you're about 60% stocks, 40% bonds and cash.
And just to clarify, why are we shifting more to bonds as we get towards that retirement age?
The theory behind that is that you want to have less risk in your portfolio when you get to retirement. So that's what those are designed to do. And in fact, 60-40 at 5 years out turns out to be about 50% stocks at retirement in those portfolios, and continues to slowly decrease and add more cash and bonds over time.
Right. So it's a way to get kind of a diversified portfolio that tracks over, call it 30, 40 years, that shifts you out of the kind of higher volatility equities and moves towards lower volatility or as a percentage bonds.
Exactly.
Okay. Now, I guess my question here is sort of, again, hypothetical scenario. It worked before. It's gotten me here. It's, gotten us to a place where we're comfortable retiring. Is it necessary to fix something that's not broken? Why would I trim that or move away from that target date fund?
Yeah, well, a great way to put it is what got you to retirement is not exactly what's going to get you through retirement optimally. So we want to look at individually, what are your individual expense needs going forward, kind of health expenses, what kind of distribution plan do you need individually for your portfolio. The target date fund is set up for a one-size-fits-all approach, which isn't necessarily optimal for everyone. So it's worked to maybe get you to retirement. Now we need to look at strategically what's going to get you through retirement.
Yeah, I think about in my my younger years, that we were accumulating. We were just adding. We were, when the stock market went down, we continued to add in every paycheck. Mm-hmm. Now we're looking to enter a phase where we're withdrawing and taking distribution from that portfolio.
Exactly. So, while you're growing your assets and you're not retiring for many years out, and adding to the stocks and the bonds with an allocation, works out great because you're investing. That's the key part to grow your assets, is make sure you're investing and allow it to be diversified for growth. But when you get to retirement, now we have different needs that we didn't have before. If we have a drop in the stock market right now, a significant drop, then we need to have assets strategically earmarked for that need for the low or short-term expenses outside the stock market.
Yeah, that feels different from if I'm selling from that target date fund, then I'm selling that portion of equities and bonds. Whereas if I'm selling from a plan, I might have a different mix of distribution.
Yeah, exactly. So essentially, exactly when you sell from a target date fund, you are essentially selling both stocks and bonds at that allocation. There are things that they do within the fund to try and minimize that, but that's essentially what you're doing. At Vector, what we want to do is utilize an investment approach where when we meet with our clients, we're first figuring out when do you need distributions from the portfolio. And then we use that through our proprietary software, Sojourn. So we use Sojourn to put up a financial plan designed specifically tailored to that individual's needs. When do they need to distribute? Well, that's going to determine how we're going to invest their portfolio. Assets that we need to distribute in the short term in the next 3 years, we're going to have that out of the stock market in low risk investments designed to be there no matter what happens in the market. It's the longer part of the portfolio that we are comfortable investing stocks and taking on and getting rewarded with the long-term growth that has historically occurred in that part of the portfolio.
Yeah, let's talk a little bit more about kind of that personalized income planning in retirement. What are some other considerations or factors that go into that?
Yeah, so first off, want to know what tax strategies we can utilize. What's your current tax situation? What's it going to be long-term? What can we do with potentially Roth conversions, distribution plan? How much should we take out of your IRAs versus your taxable assets each year, strategically and optimally? We want to look at optimization of where we invest certain assets within the portfolio. Where do we put the stocks in the portfolio? Do we put them in the Roth IRA, the taxable account? Where do we put the bonds, et cetera? That's optimization strategy for asset location. We also want to look at estate planning where, make sure your beneficiaries are properly set up. We want to look at risk management, what potential risks are out there like long-term care, optimally plan for that. All those things come into play.
Yeah, I think about our kind of beneficiary balance, right? In our hypothetical here, I'm 60, 65. I've got a couple of kids, maybe grandkids on the way. It'd be nice to leave them something. Am I able to think through that legacy?
Yeah, exactly. So one of the things we're constantly doing with our clients in our planning process is figuring out what's the long-term projections looking like. And many of our clients have very strong financial plans. And we are actually asking and talking to them about what is it they want to do for themselves going forward that they haven't done yet that might be more expenses in the short term. And if not for themselves, what do they want to do potentially for family members or charities while they're living so they can see the benefits while they're there versus have it be transferred to them upon death.
Yeah, this seems like that is a good distinction between the target date fund and a more personalized, in our Vector's case, Sojourn plan.
Absolutely. So example there would be with the target date fund, it's essentially decreasing your equity percentage every year. Well, we have clients that their portfolios are expected to grow long-term because they don't need it and it's earmarked for inheritance for their kids or whoever. Well, in that case, we can take on more risk and actually have more stocks in the portfolio.
Right, that makes sense. So the next generation is going to realize the equity and that their runway, their glide path is they may still have 20, 30 years.
Exactly. And in fact, just a client perspective, 25 years from now, if you're living, we need to have that stock in the portfolio for growth to outpace inflation.
Let's talk a little bit just about kind of the behavioral side. As I'm switching from the accumulation, I may be even attached to this target fund. I've used it, the last 20, 30 years. I feel good about it. It's gotten me here. How do we think about flipping that switch and moving into kind of that behavioral coaching?
Yeah, well, there's two thoughts there. Number one is with a non-target date fund where we actually have the bucket approach that we utilize, when there is a stock market drop, we're able to strategically and take out assets that were earmarked for short-term needs outside the stock market during that time that are probably actually positive at that point. Let the stocks that are down regroup, stay invested, and get rewarded still long-term. With the other side of it is with the behavioral coaching is when the market's down, especially during retirement, that's a different feeling than when you're growing your assets and able to contribute at a lower point. Now we're withdrawing from the portfolio. It can be a lot more stressful for clients during that time frame. We actually are calling our clients during those times, seeing how they're doing, making sure they're comfortable, A lot of them are stressed during those times. We talk them through it, explain what's going on in the market, explain where in their portfolio the risk is occurring and the drops or the downside is occurring. And with our portfolios, it's actually the long-term part of the portfolio. So we talk them through, and it actually helps with the bucket-based approach. Most of our clients are much more comfortable with that and able to stay invested through that, and if sometimes actually add stocks at that time.
Yeah, so it sounds like the old plan wasn't wrong. It's just maybe not well suited towards the new environment, new reality of retirement.
Exactly. Again, what got you there doesn't necessarily make it what's going to be the best optimal strategy going forward. And we want to make sure that we're optimizing for each individual client.
Let's talk through a little bit of the logistics. So if I've got that 401k plan and it's got this target date fund, my wife and I, we're ready to retire. We come to an investment advisor like yourself, like Vector. Yeah, how does that work? Kind of walk me through that a little.
Yeah, well, again, the first thing we do with new clients is go through and do a sojourn plan tailored to their needs, figure out the optimizing of the investment portfolio based on their individual expense needs going forward. That drives the allocation. So we come up with that, and then we say, okay, let's consolidate, say, an old 401k that has that target date fund, transfer it to an IRA where it's diversified based on our investment allocation. Because it's a 401k, you can transfer it to an IRA or a Roth IRA if you have Roth assets in the 401k at no tax implications. So it's a very simple process.
So if my wife's portfolio is at Fidelity or mine's at Schwab or another custodian, does that matter?
No, we personally use Charles Schwab as our custodian at this time. We do review that constantly and make sure that's a company that we feel comfortable with.
Yeah, so it sounds like it's kind of easy enough just to transition that 401k into a diversified mix that that we can kind of have levers and dials to pull on.
Absolutely. It's a very easy process for us at Vector.
Well, Mike, this has been a real pleasure to have you and to talk through why the target date funds work but might not work in retirement. Thanks so much.
Appreciate it. Thank you, Ezra.
Hey, thanks for listening to our podcast. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or